Sunday morning. I feel like this is like my new Sunday morning routine now. It's kind of,
Yeah,
it's kind of weird, but it's
you're
just
being
part of what
productive.
it's part of what I do. I have to get the kids out of bed, but that's okay. So they, okay. So then what we'll do is we'll open up the question and answer. I don't know if you can see it on your side, Brooke. Can you see who's
I just see
registered
you
in?
and I see you and me right now. That's it.
Okay. Okay. So as any questions come in, I've got a question and answer box that pops up on the side. And then, so if anybody has any questions kind of thing, I'll read them out and you can answer, and then we can go from there. And I will keep it anonymous. I slipped up one week and said people's names, which I wasn't supposed to. So because everybody's asking personal questions, potentially, right? So there we go. Yeah. So thank you for joining me Sunday morning.
Yeah, thanks for having me. It's great.
And Bill is saying you should be able to see the questions. So, see, I just did it already. So actually, it's Bill Butler. He's joined us He's joined me a couple times.
Oh, I can see it now. Great.
There we go.
There it is.
Thanks, Bill. Okay, so you're both. He's asking if he's famous or infamous. Yeah. Kind of. I think he's both. So we're good. But yeah, Sunday morning. So Brooke, thank you for joining me. Brooke, you and I have worked together for probably about 6, 7, 8 years. It's been quite a long time. You look after my personal kind of thing, but you also help out my clients as well. So I thought this was a great opportunity for clients that don't have a financial advisor, or maybe hasn't been in touch with their financial advisors and just don't know what's happening with the markets. And there's questions, uncertainty, or fear. So I thought, you know what, you talk to me like I understand it. So that way, because although I'm in the mortgage business, which is the numbers, when it comes to the financial, like your side, the investments kind of thing, it's a little bit French to me, but you always speak to me that I understand it, so which is awesome. So I know people joining us will be the same. So thank you.
Okay, thanks for having me. I think what you're doing with this is awesome. Like you're getting a lot of knowledge out there with your different topics, and I think it's very helpful to people when there's so much uncertainty out there, and we're in a, like you and I are talking Sunday morning through a Zoom video. We probably wouldn't do this without a global pandemic happening right now. So.
Honestly, we wouldn't. I'm doing it with a lot of business partners and on the different topics, but I'm also doing it with girlfriends now. Like it's, it's changing our world. So there'll be a lot of changes, I think, on the other side, but it's just a matter of how is it going to look.
Yeah.
Yeah. So how about you introduce yourself and then give a bit of background on you? I know, but the people who are joining us don't.
Yeah. Okay. Well, great. So my name is Brook Dyson. I'm a CFP, which is a certified financial planner, based out of Burlington, Ontario, is where my office is. I work with a firm called Edward Jones. We've been around almost 100 years now. The firm, we've been through ups and downs and recessions and depressions and all that kind of stuff. We are a brokerage. We're a full service financial brokerage. So what that means is we offer lots of different things for our clients that they might need: stocks, bonds, mutual funds, life insurance, that sort of thing. But we offer all those products in the context of a written financial plan. So what I do is, when working with clients, I figure out, I got to figure out what's important to my clients, because that's what's important to me when I'm working with them. I have an established process to put together, personalized strategies to help them achieve the goals that we discuss up front. And then, I partner with my clients throughout their life to keep them on track to reach those goals. So we use, the market, sort of what we're talking about today, is like one of the ways we do that to help clients meet their financial goals. So there's the saving and investing. There's the investing part, and there's the saving part, and then a big part of my role with my clients is the psychological part, right? So it's like these days, it's a lot of hand holding. It's a lot of, hey, you're going to be okay. Here's why, or you're not going to be okay, and here's why, and we can help run the numbers and connect the personal emotions to what they're seeing out there on the TV and in the media and in the markets and whatnot.
There's so much, I wouldn't say misinformation, but I think there's so much information, and it's how do people interpret it, right? So it's a matter of going to the professionals, and sometimes people don't realize you don't know what you don't know, for one, and then you've put your money in an investment and you just leave it and forget it, and it'll just ride out and it'll be okay. Or I think there's the opposite, where people see it and go, oh my God, I'm down, 10, 20, 30%. And what does that mean?
Yeah, I mean,
that's where they come to you.
Yeah, a lot of it these
Hopefully.
days.
Yeah.
I'm talking to people like you watch the news, and the job of, like, let's face it, the media is to grab eyeballs, right? Good or bad, that's what they're doing.
Yep.
So, we like to say in the absence of sports right now, there's the stock market. So when you see, massive losses in the stock market, the conversations I have with people is how they compare to that. And a lot of the times, if you've got, a plan in place and the diversified portfolio of investments, you're not really what's in the stock market. You could be, a lot of people are, but it's more about, we try and make it more about the client's goals and how they get towards their goals. And there's a lot of noise out there, good and bad, but we're
Yep.
just trying to get towards their goals and help them reach their long-term, goals, really.
Absolutely. So here, it's funny you just tapped on that, because I know we talked about this briefly last week too, because in the absence of sports, we're seeing a lot more people getting involved in like day trading, kind of
Yeah.
thing, or paying attention to the stock market more than ever.
Yeah.
What's some advice? Again, I feel like we should do a disclaimer for you, kind of thing, being a financial planner, right? So we just want to make sure that this is a general conversation and
Yeah.
everything is like specific to your own personal portfolio, right? Like that's
Yeah.
one of the big things that I think you have to worry about as on the investment side.
Yeah. I mean, like, generally, like, my investment philosophy and my firms, and what's sort of the reason attracted me to the firm is, we're pretty boring investors, right? So buy and hold, buying quality investments, looking for good companies that, we know how they make money. We're pretty sure they're going to keep making money. And as an owner, they'll pay you part of the profits of that through dividends, right? And we take
Right.
my clients and I, and our firm too, we take a longer term horizon than a lot of people do. And that's because we want, again, we want to match those investments with our clients' long-term goals. And most of the time it's retirement planning. Sometimes
Yep.
it's saving for education. Sometimes it's saving for a cottage or a new house, or, sometimes it's making sure you can pass wealth tax efficiently through the generations. But it's not, the clients we work with are not really, like, trading day to day. That's really tough to do, and some people can do it, but it's not
Right.
what we do.
Like I know I was speaking with a client last week, and that was one of the conversations. Now that he's laid off, kind of thing,
Mhm.
there is no sports, and he's always had an interest
Mhm.
in the market. So he's actually taken some courses to learn, but it's also I think you could potentially get trapped tripped up in that in terms of big losses or potential big gains, but I don't know. But I think that
Yeah.
is that more of a risky thing in terms of day trading when you don't have it as a background, or what's your thought on that?
Yeah, I mean, there's lots of, yeah, I mean, there's a huge regulatory framework around what we do for a good reason. And that's, we deal with people's
Right.
life savings a lot. So we're very deliberate in the research our firm does in terms of the investments that we're looking. We have a whole team in St. Louis and Mississauga that all they do is follow these companies all day long and talk to their management and find out how these companies are operating and what their balance sheets are like. And especially these days, if they've got enough cash on hand, how they're going to make it through all this. Can they pay their dividends? So our team of analysts really provide a good backing for our clients in terms of what really is a quality investment. What does that look like? And if things
Right.
change, because things do change, should clients still hold this investment, or should they, maybe it's time to exit that from their holdings, or maybe it's time to add another quality investment in there based on some sound research that our analysts are doing.
Perfect. There was a good question that just came in saying, right now, this is a scary time is this a scary time for advisors? And I expect a lot of those inexperienced investors are emotional. So does that give professionals an opportunity for larger gains?
I guess the first question there is this a scary time for advisors? I don't know if scary is the word. We've been preparing for this for like personally, we've like for the last, so we've had a market that has been so good for 10 years, and it just kept getting better and better and longer. So
Right.
the sense within advisors and the investment community is like, okay, this is too
When's
good to
it
be,
coming?
it's really good. So
Right.
we've been preparing for something. over the past couple of years, you build a diversified portfolio. You don't just put all your money into one thing. You put some, fixed income and things like that in there that may slow you down in the good times, but they're going to buffer you for times like this. So we weren't necessarily ready for a global pandemic and a virus, but it's, we've been ready for something. So clients are, it's not great to see you lose money, but you got to keep in mind that we're working towards a goal. We're not focusing on the day-to-day shift in the markets. And, if you sort of put that on its head a little bit right now too, if you can, I think Warren Buffett has said be greedy when everyone's fearful, and fearful when everyone's greedy, right? So the best time to buy investments, if you've got extra money, is like when it is now, really hurting to do so, right? So
I know it's a catch-22.
Buy low, sell high. It's tough to do though. It's really tough.
And we've always and how do you time that, right? So one is like right now we do well. Yeah. Right now we think it's buy low, but I think you and I were talking that some of them are actually, it's not as low as we initially thought. Is it not? Some of the markets coming back.
Yeah, so I think the low for this year right now, in general, from the top of the market, the low was reached almost really about a month ago now, like March 23rd, I believe it was, and it was down.
Yep.
Don't quote me on this. I think about 30%, and that we've been going up in fits and starts since then, and it's the market's recovered. Significantly, very significantly since then. We've had some of the best trading days in the past 100 years in the past 2 weeks here. 3 weeks.
When you said that to me the other day, I was like, no way. I thought, I don't think most people know that. Because I think everyone thinks we're still in that low time.
There could be more to come. Like, nobody knows.
Absolutely. Waves.
The name of the game right now is volatility. Like, things are moving around a lot. And we, our analysts, our strategists think that that's going to be the new normal for a little while, is ups and downs, and but long term, investments are a little bit cheaper than they were 2 months ago. And it's, if you're a long-term investor, what we like to tell our clients too is, stay calm, stay invested, look for opportunities, right? So don't
awesome.
Don't no knee-jerk reactions, but just be prudent out there.
Right, and be aware, and then have the conversations with the professionals if you don't know, right?
Yeah, yeah.
One of the things I think we on the mortgage side is that clients have. I personally haven't had any clients deal with this, but in terms of with the market coming down, and that was their down payment as a first-time home buyer and taking it out of their RSPs, and then down payment disappearing. But in my thought on that is, now this is just based on what I would know, is that if you are working with an advisor and they know the goal is to buy a house, it should be in like a lower risk type of portfolio at that sense anyhow, correct?
Yeah, and that's what we've done generally over the past number of years. Like, if a client comes to me and says, I'd like to invest this money in buying a house, it's, well, hold on, like, when are you buying the house? And so let's just put this down payment to the side, and if it's in cash, it's safe, it's going to be there when you buy the house, and you're not subject to the value of the market when you want to make a momentous decision in your life. It's just being prudent, right? Yeah.
Absolutely. And having the right conversations, not just putting it in and going, oh yeah, it's okay, I got my tax refund, right? So and then that way we're okay.
Yeah, you got to think of, part of my job is thinking about the downside of everything, right? It's a lot of times I'm the
doom and gloom guy. No.
But it's like think of it, it's like called like stress testing your financial plan, right? Like putting in worst case scenarios in there just in case. And then, taking advantage of the good times when they're good, but building in the fact that it's not always going to be good, and you need that.
No, exactly. And I think you have to know that going in for the long term, right? Is that there's peaks and valleys, and you ride them out. It's the same thing with a variable mortgage or a fixed mortgage. It's
exactly.
It's the exact same thing, right? Yeah.
Yeah. It's you've heard for years. You hear like in the media and whatnot, and financial planners always talking about something like rules of thumb, and like how much do I put in an emergency fund? Some people say 3 to 6 months. It depends on your financial plan, but it's like this is why you have an emergency fund. Like, we're in it right now. This is the rainy day. Like, this is what you've been saving for.
I agree.
Yeah.
And I've talked about nest eggs and rainy day accounts and all that is, yeah, you're right. You need to have that 3 to 6
We're in
months.
it.
And sadly, most people don't, like, kind
Yeah.
of thing. Just
Yeah.
based on life kind of thing, whether
Yeah.
it's life, or knowledge. And some people just don't have the right knowledge or advice, right? Or guidance
Yeah.
kind of thing to actually set it up properly.
Yeah, I mean, like what we're in right now, like with the economy, we're just sort of starting to see what the ramifications of shutting down the economy really is like, and it came so fast, right? We're in
Oh, I
a
know. Oh my
this is a
gosh.
health crisis that's turned into an economic and a financial crisis, and it's it's unprecedented how fast this came, and yeah, it's
I
very
agree.
worrying for some people.
Absolutely. So now one of the other, so I think we had talked about that. I was like, what about that young investor who's been in it and not too sure? Is the main questions you're getting is, am I going to be okay?
Yeah,
Right.
yeah. I mean, if you have a longer term time horizon, like what I said before, stay calm, stay
Yeah.
invested, look for opportunities. Things that we advise, things that clients can do these days is something called systematic investing is a good idea where you're putting, a set amount of money into your investments on a regularly scheduled, maybe monthly basis. So, when things are down, you're buying a little bit more of it. When things are high, you're buying a little bit less, and it, smooths out your returns. And
Yeah.
it's really good for you down the road to be doing something like that.
I totally agree. And it's not necessarily putting it all into RSPs. It's even just putting it into savings. So that way, when you need access to it, you've got the access.
Yeah, I mean, like,
right.
It's the act of saving is pretty much paramount, and then you can, work with your tax advisor to figure out the details of where it should be, or your financial planner to, put in this bucket or whatnot. But you gotta save, right? Like and it's tough to do it
Absolutely.
these days. Like we're under no illusions.
Which we know.
Cash flows are tough on households, right? So.
Absolutely. Now, one of the big questions I've been getting, I sent you the email, it was from a client, is do they invest in oil and gas? I think it was oil, right? It was like she had some extra money and she was like, I don't know who to ask, so I'll ask you. So of course I'm like, well, don't ask. I've got a guy. So I reached out to you, and she was like, do I invest in oil because it was cheap? And I remember your response was no, because of what was happening over in Europe with the Russians and such, I believe. Is that right?
Yeah, so I mean, it's like, just I'll preface this,
Or
like,
maybe it wasn't that it was a no, it was, but there was better choices.
Yeah, I mean, talk to your advisor. Everyone's situation is different, but what has happened with the oil market is, decreased demand, right? People aren't working, people aren't, putting gas in their cars, factories aren't running, so there's this decreased demand. And at the beginning of all this too, there was, an increased supply on the market because of, geopolitical disputes or whatnot. So there's lots of supply, there's way less demand. So, laws of supply and demand, the price goes way down. And then you've started to see like some interesting things in the market happening. The price of oil's gone way down, and it's cheaper to fill up if you are filling up these days.
Right.
Things like that. But yeah, I mean, it's specific cases. Yeah, talk to your advisor. There's a place for most things in portfolios, maybe. But it's you just gotta figure out your own situation and what's good in there.
And figure that's good. I was actually on a webinar last week with the David Chilton from the Wealthy Barber kind of thing. Yeah, that was actually one of our industry presidents. He had actually put it together and invited everybody, not just his network. So it was kind of cool to actually listen to him.
Oh yeah.
And one of the things he had said was that everyone in their portfolio should have some gold, whether it's a little bit or whether it's not a little bit. And then I had a conversation with a client literally the next day, and he mentioned the same thing. And I thought, I'd never heard that before. What's your thought on that?
Yeah, I mean, gold's like, it's an asset class, right? So it's a type of investment you can put in there, and it's one of many different asset classes to go in there. It's gold generally it's a storage of value. Gold prices generally go up when times aren't great because they, you can feel it and touch it. But what is gold though, right? It's if you're buying gold, it's not really generating any value You're not getting a dividend from gold. It's not a business. Whereas if you bought
Okay.
stock
Gotcha.
with a
Okay.
dividend, you know that you're buying that stock because that company does something and creates profits. Gold is just a place people go, good or bad. That's what happens. People go when, generally when it's fearful in the markets, and then out of it when times are a little bit better. So sure, it has its place, and a lot of our portfolio managers that we use have gold weightings in there. But again, it's
okay.
up to your personal situation whether you put it in there.
Right. Okay. But that was interesting. That was the first time I'd actually heard it, and I thought, okay. So we have
Yeah.
another question that came in this morning: is should the young people rely just on their employer's pensions and retirement plans, or should they be being a little bit more proactive on their own as well? What's your thought?
Yeah, that's a really good question. It depends on your situation. What we do with a lot of our clients is when we first meet them, those with defined benefit pensions, say they're government workers, or they have they have a good pension, or there's a defined contribution pension, or like a group RSP. When we first meet clients or prospective clients, we take all of that into account, and we work it through the financial plan. So we figure out, first we got to figure out what's important to them with their goals. So generally it's retirement. So when you're talking about pensions, when are you going to retire? How much you want to spend in retirement? How comfortable are you with volatility in your investments? How much should we be saving? Once we sort of put all those pieces in there, and the pension is one piece, then we say, okay, maybe there's a hole here. Maybe you should be saving X amount into your own, TFSA or RSP. It depends on what you're doing, but it's not a black or white answer. Generally, you got to look and say, does this pension match what I want to do down the road? And a lot of times it does, right? Like, my brother's a fireman, and he's got a great pension, and that might, that might cover what his
What his needs are.
His needs are down the road, but it's all unique,
right.
And you should model it out. Like, it's a really good exercise to model it out, because you don't want to get to 60, 65 retirement and then, open the package
this
up and
is
say,
it.
What do I get? When you could have
right.
been putting away, $100, a couple $100 a month, when way in the past.
Agreed. And then based on these unsure times that we're coming into, it's like, I think as maybe potentially we might see employers, whether that's going to be some of the things they cut back on. Like, I know, right now, DeFasco, I know, has, if you're on a salary, they've cut the salaries 10%. They've got rid of the contract workers, and the regular workers are still okay. But I'm thinking, if they want to keep everybody employed, maybe that might be something that we might see getting cut back is benefits and pensions potentially, kind of thing.
It's happened.
Absolutely. And it's like to keep everything afloat, right?
Yep. It's good to just, and when you, if like, from the person who asked the question, if you really want to know that, probably talking to an advisor or human being is probably the best route. But there's also stuff online. You can find calculators. You can, we have a simple one on our website. But most advisors will talk to you, and you want it, when you talk to an advisor, you want to ask you a lot of questions. The pension is one of those things, because they want to get a whole idea of what you're doing, just to help you get to wherever it is. And then, just opening the pension package at 65 could be a terrifying experience if you haven't. Oh my gosh,
no kidding, right? No kidding. So now, okay, so let's say it's the client that I know, say they've worked for a company and then they've left, and a lot of people will actually just leave their pensions there, thinking they've got options, but they don't know what to do. But they can transfer that out to yourself, can't they?
Yeah. There's we work with a lot of clients who sort of sometimes leave these like trails of pensions behind. And what we like to say we do is we make a little bit more sense of what they have and work it into their plan. So you can, if you have previous employers that have, sent you packages saying, hey, you got to deal with this, instead of, again, dealing with it at 65, get it all together, go talk to an advisor, and they can help you make sense of it. And most times, you're able to sort of consolidate them into one place. So you have an idea, and sometimes you just leave it. Maybe you do leave it with the pension provider if that's better for you as a client. But it's good to just make that analysis, look at the pros and the cons and the tax consequences, because there are huge tax consequences sometimes.
But if you transfer it from an employer out to an individual?
It depends. Yeah. It depends on a lot of
how
things.
it was set up? Okay.
Yeah, how it's set up, your age, I like to joke, everyone who you went to university with who has a math degree, you know, half of them work for their actuaries with these pension companies, because it's a
Perfect.
complicated calculation that's unique to every single person, and you like talk to your tax professional first, talk to your advisor before you do any of this, but it is possible. Yeah.
Okay. So then if now we're in these times where people maybe need extra cash flow, they can take from their locked in pension, can't they, as an income? Like if you convert
Yeah,
it to like a LIF, is that right?
there's rules around it.
Yeah.
I mean, the term you just used, locked in, is there's a reason for that too. A lot of it, you can access your savings. Yeah, I mean, it's
Right.
not. It depends on your situation.
Correct.
There's tax consequences. Talk to your tax advisor, but the possibility is there. But then you need to think, you know, cash now as opposed to retirement later, because that is pension money, right? So
Right.
you got to take a look at the big picture with it
Like the whole
always.
picture. Because I think with the LIF, isn't there like a minimum or a maximum that you have to take every year?
Yeah.
The
With
locked in one?
LIFs and life income
Yep.
funds and RRIFs, retirement income funds, there's minimums that the government wants you to take out once you hit a certain age.
Yep.
With the LIF, there's maximums you can take out each year, and the reason for that is because it's pension money, right? And the government
Right.
doesn't want you to empty those right away. I
No,
mean,
they want to be there. Yeah.
yeah, there's certain caveats to that and exceptions, but it's pension money. It's money to be used for the future, and that's why there's just those rules around it there.
There was just some rule changes to the RRIF income though, wasn't there?
Yeah,
Yeah.
so the part of the relief package is those folks that are pulling money out of their RRIF right now. The government has proposed, I think it's in effect now, 25% reduction in the minimum you have to take out every year. So generally, you know, there's lots of different ways about this, but generally when you turn, by the time you've turned the year after you turn 71, you
Yep.
have to start pulling out of your RRIF, which is
Correct.
a previous RSP, right? And
Yep.
it's a percentage of the total value in there is the minimum you have to take out every year. So the federal government has said, as part of this relief package, is that minimum, they've reduced that by 25%, so by about a quarter.
Okay.
Yeah.
Okay.
For people who haven't pulled out yet, right? So if you have your annual payment coming in July, or if you've got like monthly payments, if you don't
Yep.
need it, yeah, you have the option to reduce that by about a quarter, if that works for you.
Which is perfect, especially at a time where the markets are lower, right? Because that's when we say that's not when you really want to potentially cash out. But it
Yeah.
also depends what you're invested into at that age as well,
Yeah.
right? Like again, it's a case by case scenario.
And that's why the government did it, because generally
Okay.
RRIF accounts have taken a hit, right? As most investments have. Yeah.
Absolutely. And I think one of the things on our side, on the mortgage side, is that we were talking of clients that are potentially even getting the reverse mortgages, kind of thing, to offset the income. So if they don't want to take as much out of their investment portfolio, because on a reverse mortgage, you have the option of a lump sum or a monthly draw as well, like to help
Right.
offset, depending on, again, case by case scenario. Or
Right.
there's the option of having a secured line of credit, right? So that way, it's the lowest borrowing that you can do at an interest only.
Yep.
Some clients are even using that to invest in the market now too.
Yeah, and again, it depends on your situation, and you have to be aware of, you know, your risk tolerance comes into it huge, and your written financial plan, whether you can, you know, if that's a good strategy. Again, talk to your tax advisor, talk to your financial advisor, your mortgage broker.
Yep.
Everyone's unique, but yeah, there's lots of strategies out there right now. Yeah.
And I think it's always it's finding the team that works best for you, right? So that's got the same like-minded kind of thing, so that way you can help grow together as well.
Yeah, like we like to say we're the I guess the term quarterback sometimes. Like we help our clients out. A lot of our clients have, you know, accountants and mortgage professionals and other professionals in their life that help them manage their finances and money, and we're able to sort of work with those professionals to help our clients achieve their long-term goals, because there's a lot of times there's a whole team of people behind clients to figure out how to advance what they need to move forward on.
Oh, absolutely, right.
Yeah.
And and everybody, and you need some guidance at some point or other. Kind of,
Yeah.
it's no different than I it kind of makes me laugh when I see those commercials you can do your mortgage application in 30 seconds or less. And I'm like, you got to be kidding.
Yeah.
It's so complicated now, and it's no different than investments. But I think
Yeah.
what some people will do is, if say, I keep going to RSP, but if they put contribution in, it's like they put it in the cash account and forget about it because they've done their
I see that all the time.
right?
Like,
I
like
know.
with work plans, people just put it in cash, and then 10 years later they come to us and say, why hasn't it grown?
Right. But it's almost like, and you can reach out to them and talk to them, but it's a matter of, they think it costs money to work with an advisor. They think they're out of pocket the money, but they're actually not out of pocket money for to work with a financial advisor.
You gotta find value, right? Like
Yep.
it costs
Yes.
There's costs there, and you have to think that you're getting good value. If you're not, then maybe that's not the right relationship for you. Like a good analogy I like to use, because it's hits home a little bit more, is with a will, right? You can write your own will. Do you want to? I don't know. Like, you probably want a lawyer to look over your will if you want your assets to go to the right place, if you want the right people looking after your kids when you pass. That's worth it, paying that lawyer to do that. So if you want the proper outcomes, a lot of times you need professionals to help you get to that place.
Correct.
I mean, we live in a world right now where you can, like you said, you can fill out mortgage applications online, you can do your own trading online, you can do your own wills online. Do it, sure. But there's downsides. The upside is cheaper. There's downsides. You might not be getting the full vetting of what you're doing, and maybe it won't be appropriate to what your situation is.
Well, it's funny you bring up wills, because it's also more conversations we're having about life insurance in this time, and I think this is what it does. It brings stuff to the forefront as well, right? Yeah. So are you finding that yourself in terms of, are people asking you a little bit more?
Yeah, I mean, you have, like, the conversations that we have with our clients and prospective clients these days are, this is a health crisis first and foremost, and people are, everybody's lives have been changed by this so suddenly, and some people are thinking about their own mortality because it's that's what's on the news. Like, there's statistics about how many people have died from this and how many people are getting sick. So people start thinking about worst case scenarios, and a lot of the times those life insurance conversations are, how can I protect my family? Is my family going to be okay if something happens to me? So yeah, we are having more of those conversations with clients, and it's you need to fit what you want the outcome to be, and then sort of work back for them, make sure you can afford it, make sure it's proper for you, all that kind of stuff.
Absolutely. And that's what I have those conversations at mortgage application time as well, in regards to mortgage protection plan, right? Whether it's life insurance or disability. Now, do you offer disability insurance as well? I know you do life, but I don't know if you do disability. You have the disability package as well?
Yeah, we do. Personal, like more. So we do life insurance, both permanent term, critical illness insurance. So if you were to come down with a severe illness that doesn't kill you, you survive from, that's a very good set of coverage. And disability insurance as well. Yeah, if you can't work and you need to cover off your pay for X number of months. Again, it's unique for everybody. Everyone's got different needs, and we try and fit those solutions for the needs that the clients have. Like, we'll do a needs analysis right up front, and then we try and work backwards and say, okay, what's the appropriate product to put them into to help them achieve their goals and their needs.
That's awesome. Perfect. Yeah. So it's not always just about the investment, is it? Kind of thing. It's all it's the whole. You
got to build a moat around it. You got to protect it, because if you like, say you're the primary earner in your family, and you have a stroke, and you can't work, and you can't, you're very sick, but you haven't passed, so the life insurance doesn't kick in, but you can't work. A lot of times people, if they'll need to dip into their savings to help provide for their families while they're sick. Something like critical illness insurance protects your savings and says, okay, you've been diagnosed with this illness. There's some money that's paid to help you cover costs and whatnot, tax-free a lot of the time too. So
exactly. And then now that's to have it with yourself, and we even have the option that on the mortgage we even if you have like the disability package there, it'll actually make your mortgage and property tax payment for you while you run a reduced income as well.
There's
So that
tons of
way there's
options.
different things that you can marriage together, right? So which is awesome.
Yep.
Awesome. We talked on it a little while ago there in terms of the different times we've had different crises. Like there was the 2003 where we had SARS, and then there was the 2008, 2009 financial crisis that we were in. Now we talk about this one being the health one. Kind of thing. Do you see any similarities or any differences?
Just from our point of view with, savings in the markets for, their investments and their retirement savings, sure, it's we've seen a significant drop in the markets. We're right in the middle of it right now, so we don't know if we're out of the woods, or we seem to be right in the middle of a lot of things right now. And what makes it similar to 08, I think, but what makes it different is a lot of people are losing their jobs, and there's,
I know,
it's sad, and it's
did that happen back in 2008?
I know it was sort of, to put it in perspective, like just from the market. So we reached the March 23rd, the bottom we've seen so far from its high. That came in like 3 weeks, 4 weeks, which it took like months for that to happen in 08, 09. So it's moving much faster this time. So that's why you see a lot of the media saying, oh, this could be quick, could be not, like who knows. But what we do know is it went very fast, very quickly, with the markets, and nobody, everyone's just government's trying to figure out now how to reopen the economies and whatnot. So to answer your question, there's definitely similarities there. Hopefully our analysts and our strategists, we do think this will pass, and there will be some growth in the markets afterwards for your investments. So don't generally, if you don't need to, you're not selling when it's at the bottom.
Right.
Like what Buffett says, buy when people are fearful. It's
right. Okay, so that was that's awesome. Is there anything that I've missed out on in terms of a message that we can share with everybody?
I don't think so. I mean, so go ahead.
Yeah, I was gonna say, like, I know nobody has a crystal ball, right? So it's a matter of, like, if we look at timeline of recovery from like 2008 or even 2003 kind of thing, and again, because it was quicker now, do we think the recovery will be a little bit quicker kind of thing because of the comeback there, or do you think it'll probably be the same, or it's going to be an individual scenario?
I don't know about the recovery. We know there will probably be a recovery. We do know the governments, the U.S. government, Canadian government. I think some of the lessons learned from the last financial crisis were, act quickly and sort of act.
Right.
There's more money going in right now to save, to try and save jobs, small businesses, all businesses.
Correct.
Like these unprecedented, stimulus being pushed out by the government. So that's a little bit different. It's quicker this time.
For sure.
But I mean, like, just for clients, just make sure you know what you have and how things are moving forward. I know, if you have a written financial plan and you've stress tested these things in, or you've talked to your advisor and they've actually taken a look at your portfolio and your goals, there is a way forward from this. But just a lot of times, just blindly, waiting and seeing may not be. It may work, but it may not be the best for you. But talk to a professional just to see where you are.
We're absolutely, which I think that's the key with everything, right? It's whether it's an advisor that you know and trust and has like-minded goals, kind of, which is no different than working with myself, right?
Exactly.
Kind of thing. It's I have to be on the same page. But as you were talking about how it happened really quick, the same thing happened with the mortgage markets, right? Like the rates and I was kind of like, my analogy was it was on a trampoline. It's like it literally. It shot down, but it shot right up just as quick. And then there was so much volatility with the bond market, which we know is what dictates the fixed rate market kind of thing. So, and then the lenders were padding those rates. So that way to handle all the fluctuations. I said they were on like a pogo stick It was a little bit crazy there for a bit, but now we're starting to actually see them come down again. Like I've actually seen the fixed rates are coming back down, whereas our prime rate is staying nice and is low. That dropped 1.5% in like 23 days, 24 days. It was crazy.
One of the things you're able to do for, individuals is, maybe when you're looking at that mortgage and you're able, Gail, you're able to review these things, you can, just by doing what you do, is you can help with cash flow considerations with the household, right? And it's
correct.
It's freeing up, times are getting tight here for a lot of families, and if you're able to do what you do to give a little bit more cash in families' pockets at times like this, maybe that's a good thing to do.
I agree. And sometimes I say, like, rates are still low, but everyone just got used to it. People are still asking me today, oh, I thought the rates were really low. It's like, yeah, we blinked. It's like they were low, but it wasn't long. But they're still under 3%.
Yeah.
Like I'm like, we're still in the twos, like the mid to high twos. I'm like, which is great. And it's not always about rate. It's about
that's the thing I've learned from you is it's not always about rates, and I've seen that it's so true. It's about the individual situation and what they need out of it. And a lot of times it is rates, but a lot of times it's not. And it's two different rates could be, you might think one rate is better, but everything else behind it
isn't necessarily right. But that's where the education piece comes in.
Yeah.
I agree. So you had mentioned, like, with the government giving all this extra cash flow, like that's being pumped into the system to help out individuals and businesses. What do we think is going to happen with that kind of thing? Because somebody had said the other day, they were like, it's imaginary money that's kind of coming out to stimulate the economy and such. What do we see on the other side of that? Or do we know? Like, how does that, I don't even know. How does that get handled?
Yeah, I mean, that's for our elected officials to figure out. I mean, money's got to come from somewhere.
We haven't seen this before, have we?
No.
Okay, so it's not just me thinking that. That's why I'm not going, I don't know. Okay.
I mean, I don't know if all this money that they're pushing out was available before. I mean, there's monetary policy and fiscal policy that can support this. The Federal Reserve can, print money,
right,
type things, but there's going to be consequences down the road for this.
That's what I think too. Yeah.
But you know what? Like, this is the situation we're in right now. Governments are responding swiftly and decisively, and I think that's a lesson learned from last time. But how to pay for it? I guess
we cross that bridge when we get to
that.
Right?
That's what elections are for.
Right, and we talk to our trusted accountants to see what they know and how they can help us out. Exactly.
It's interesting. We're just at the forefront of a brand new world moving forward here for a long time, and we'll be
absolutely. No, I completely agree.
For a long time.
I agree. But again, so I feel like we just kind of said that a couple times, but it's working with people that are in the know and that are the specialists in the industries kind of thing, that are up to date on the changes and what's happening. Yeah. So which is awesome. Yeah. Brooke, this was fantastic. This was
I enjoyed this.
Yeah, great. This was really good. Thank you. I know you and I talk regularly, so it's nice to actually put this on a platform and share it with everybody and help answer some questions they may have.
Yeah, and this is going by very quick here.
I agree. I think we handled that. Oh, did I miss any questions? Oh, I did. My apologies. What sort of traits do you look for when choosing to invest in a company? Oh, my apologies. That was further down there.
Specific.
What sort of traits do you look for when choosing to invest in a company?
So our analysts, our company, we have a lot, I guess you call them screens for the types of companies we that eventually make it to recommendations for clients. There's a lot of things that go into that. One of them, our analysts, like I said before, they spend all day looking at the company's balance sheets. They talk to the management, make sure the management's good, who their competitors are, what their competitors think of them, how long they've been around, sort of the sector they're in, what their advantages are, all that kind of stuff. In general, I like companies that pay a dividend. Okay. That's not too high because it shows strength, and it's a sign that a company's making enough money to pay its owners, really, that's kind of what capitalism is. Yeah, and it's
right. Yeah.
Some companies don't pay dividends. Like there's companies out there that take their profits and invest them back into the company, and those are good companies too. But what traits do we look for? We like good, solid companies that have a track record of success, and we think they're going to continue to have track records of success, and they can share some of that success with their owners as well.
Awesome. Well, that was a perfect note to end on. So see, it's all the good stuff that's still out there, right? There's still, although we hear a lot of the doom and gloom, there is still, it's nice to see that things are on the upswing. And
yeah, times are tough
I feel
right
it.
now.
I feel it in my market, and I know you feel it in yours.
Yeah.
Yeah, and times are tough, and it's working with people that can make it financially easier and know the options, kind of thing, to figure that out, right?
Yeah. Yeah.
Yeah. Yeah. Well, that's awesome, Brooke. Thank you very much. I wouldn't be surprised if we do this again.
Oh, for sure. No, this is a great way to start my Sunday. I'm like, it's 10:45 here, and this is.
And away we go. See, now we all get to the house clean. Well, it's raining for me, not for you. So there you go. Okay, perfect. And if anybody has any questions, you're in Burlington at the Edward Jones office on the South Service Road.
North Service Road, 4145. Yeah, we have presence on Facebook, LinkedIn. Just search for our name on there. We're really good at getting back. There's myself and my branch office administrator, Brenda and Susan. We're really good at getting back to people, and we'll talk to you and sort of see if there's a way we can help you out if you need to.
That's amazing. Perfect. All right. Thanks so much, Brooke.
Okay.
All righty. And thanks for everybody who joined us as well. That was great. Okay. Thanks. Enjoy your day.
Thanks, Gail. Bye.
Okay. All right. Bye.